Okay. All right. Where are we? Good morning. This is Vince Lanci. This is the Opportunistic Trader and the Gold Fix. Okay. Okay. Gold is up today. Why don't I throw a chart up, a live chart? All right. Uh, okay. I'm going to reload that. All right. So that's a monthly gold. We want to do by the hour. All right. So on an hourly basis, this is the delayed chart. Gold is stronger today, 1245. That's a 10-minute ago print. Um, Interestingly enough, gold is stronger while stocks have sort of stagnated. So we can get into possible reasons for that, but let's look at that in context with the rest of the markets first before we get into the actual content today. Okay. So the 10-year is lower. There's a big deal yesterday about, I think it's the twos and fives inverting, and I don't have a chart handy for that, but that's an arbitrage, and that arbitrage is being taken advantage of. But it's important because when you start seeing headlines like the twos and fives are inverting in mainstream media that doesn't normally talk about this or wouldn't know how to talk about it, that is a signal to you that they're being, sorry, it's a little paranoid, but they're being influenced to push the recession agenda. An inverted or flattened yield curve. A flattened yield curve is recessionary. An inverted yield curve is inflationary. Now, you could say that a part of the yield curve is inverted, and therefore it's in the way on the way to being inflationary. You could also make the case that the part of the yield curve is inverted on the way to being flat everywhere else. But we don't want to make either case. As an arbitrager, if you have a yield curve that's not smooth going front to back, just think of a classic, not a sine curve, but low to high, uh, uh, a term structure, let's say bonds or gold, where the cost of money over time goes up. So your curve slopes upward, but at infinity, the curve is flat. Whenever there's a kink in a curve, you'll hear that word too. Whenever there's a kink in a curve, you there's an arbitrage to be done there with a butterfly, but we're not talking about that right now. All right. Let's go through the markets, right? Just visually before we actually read the words. All right. All right. So Asia's weaker, generally speaking. Europe is weaker. All right. Uh, the U.S. is weaker. All right. Now, just looking at these as they are, these are uh, pullbacks after an excited rally. Uh, if the pullback continues, then you can ascribe reasons as, oh, the market's really digested that the Trump thing is nonsense, which it is. But you have to trade the markets, how the markets react to the news, not how you feel the news should be interpreted. But just keep that in mind. The second thing is the second thing hanging over the market, I guess I should say, not hanging over, but influencing the market is um, is the QT concept. And QT covers a lot of areas for everyone, and it does for me in this conversation. But QT specifically means quantitative tightening, raising of interest rates at the same time issuing more debt. And every time the stock market rallies, that's uh, uh, permission for Powell to tighten. Every time the stock market drops, people think Powell's not going to tighten. So uh, we are looking at interest rate raises or not raises, or people speculating about that, and it's just speculation. No one knows. The VIX is up 2%, uh, uh, which is to say, if you're a volatility person out there, if the VIX is up 2%, uh, then and you're trading the VIX, then you're trading the volatility of volatility. Uh, we won't get into that, but you are trading basically leptokurtosis or strangles versus straddles. Uh, Brent oil, I want to talk about Brent oil versus crude for a second. I think it's interesting. And by interesting, I mean, I have no idea. how to measure it anymore. I actually do, but I'll defer. But generally speaking, I had been looking at Brent and crude as the way people look at silver and gold. And I want people who trade gold and silver to look at markets like this. Apply what you know to new markets and see if it fits. So, for example, silver is more volatile than gold. Generally speaking, except for the last 6 months, if gold would rally 1%, silver would rally 2, and vice versa. So it was my feeling that crude being the smaller market, WTI being the small market, would, as the market rallied, the Brent TI spread, or the Brent, which is the London benchmark, versus WTI, which is labeled CL here, that would, I initially, and I didn't voice this in the chat room, but I initially said, well, if WTI is lightly traded compared to Brent, then if Brent rallies a dollar, WTI should rally more because it's a thinner market and people are going to crowd into it more. But I applied the silver gold concept to it, and I found myself to be wrong right away, and I also found myself to be uh, completely wrong in an opposite way. If WTI rallied a dollar, Brent rallied $1.50. And so I came up with a thesis on that, basically saying Brent is a benchmark. People care about that more. And so if the market rallies, Brent's going to rally more and WTI is going to rally less because we have WTI and there aren't as many people buying it, embargo. And then the market dropped, $10, and the spread went from $10 to $9, and the spread should be, in my opinion, based on correlations, have shrunk a lot more, like to $7. So I asked myself again, um, what's wrong with this? Why did the spread not come in? And I asked Bryn Kelly and a couple other people, and the answer is very simple. It has to do with the inability to efficiently export a U.S. WTI. It has to do with pipelines, reversing flows, and the expression is basically throttling. So it's just not easy to get our oil out of here. We need a Mark Rich. All right, not too much more time on this. Let's go to the post. Um, uh, there's not a lot to cover, except that the market is, there's a little joke up top. Reasons to have a coworker watch. You can read that, laugh later on. All right, shape of things to come. The reason I titled this subtitle this way is because I believe, and this is a macro opinion, that QT uh, will continue to go on. If you're looking for a PAL put, all right, I'll just throw numbers at you. The numbers don't have to be exact. The timing doesn't have to be exact. You just know it when you see it. So, in a macro sense, I'm more like Larry. I know it when I see it. In a micro sense, I'm much more X plus Y equals Z. I have to do it this way, or I will go crazy over trading. And these are lessons I think every trader should know. Know your weaknesses, know your strengths. But all these million digressions aside, shape of things to come. I believe, and I'll revise my beliefs given more information. That is what being an empiricist is. That the PAL put. Let's assume that a PAL put exists. And the PAL put exists at 2,000, in my opinion. Now, for anyone to say that there is no PAL put is being ignorant, because at some point the prices of stocks do affect the economy. But in this range, the price of stocks are not a reflection of the economy. They're a reflection of algorithms and people with their hair on fire and fund managers trying to keep their jobs. So what we're getting at here is that if the PAL put is at 2,000, right, just to give you an extremely low number, then if we go to 2000, if the S&P goes to 2000, then QT will be changed, mitigated, or terminated. And by that, I mean we'll continue to issue debt, but not withdraw dollars from the market. Or we'll withdraw dollars from the market and not continue to issue debt. I believe we'll continue to issue debt and let the dollar weaken more. When that happens, right? Where I say when, this is how traders think. If it happens, but when that happens, then you'll actually see stocks scream higher because of the weaker dollar. Uh, Stocks are assets based in dollars. Stocks will go up Stocks will go up for two reasons. One, they are dollar based. Okay. Two, uh, uh, stocks are hedged for inflation in the sense that if a company's earnings are if the company's paid in dollars, then their earnings will go up. They'll earn more dollars. Doesn't mean their earnings go up in a real fashion. Their expenses do as well, if especially if they're in foreign currency. But the point is, stocks are hedged against inflation partially because uh, they earn dollars, and they'll earn more dollars because the dollar is weaker. The thing is, profit margins, if you understand the fundamentals of a business, you can only raise prices so much because wage increases will lag behind this. So that's why when after Brexit happened, you had the FTSE, I think, was like the best performing index for the year. That's because that was the booby prize for having the worst performing currency. Back to the point. So S&P goes to 2000. QT stops in some form. Dollar weakens. Stocks scream higher. But this time, right, and this is the complete conjecture thing, but this time you get a little bad inflation too, and gold is going to go up as well. Um, I don't know how that can be capped, especially if China has been dumping its dollars as it has been in a macro way. But so this, I think, is a shape of things to come. Stocks and gold rally on a weakening dollar, and stocks and gold rally on a weakening dollar, and then stocks stop rallying. Remember, gold is a hedge. Let me just end with this. Gold is a hedge for a protracted bear market in a weak dollar environment. It is not an investment. Yellow, inert objects that are very good doorstops are not investments. You don't invest in things that have no expectation of an appreciation in value. Gold has no alpha. All right, it's not managed. It's not a product that is that can be have value added to it and make it worth more. You don't expect growth from gold. You don't invest in gold. Stop effing calling it an investment. And I'll do it too, but that's just because I'm guilty of of aping other people. Gold is a hedge. If you own money, you own gold. How long will you own money? That's how long you own gold. How much depends on who you are. For anyone to say 5 to 10%, that's okay to say that. But to give a specific number is in error. For those of you who own houses and think that's your hedge against inflation, you are wrong. You're wrong because at a high interest rate inflation environment, as happened in Argentina, you will not be able to take equity out of your house. You will not be able to get a loan. You will not be able to reverse mortgage it. The banks will raise requirements. Gold is a hedge against that. Whether you can sell it or not is different. Let's go to the technicals, and then I'll get to some charts. Okay, I gave you the full technical report today. There's the numbers there. You can stretch it out to see for yourself. These are basis February now. All right. On the macro basis, I read that every day, but a lot of it is repeated because he lets you know that he's got stuff out there. All right. Upside, I'm writing this for higher call. If we break above 1252 and back below, get short and fade the high. Okay. So 1252 to 1243 and a half are his chart levels. I have no numbers up here, technically speaking, and I rarely have numbers in general until we've been in an area for a while and I get a chance to draw trend lines and do my little amateur technical analysis stuff. But what I do have is volatility based system and regression to the mean trades. Okay, a little coffee, a little refill. Again, these are not technical numbers. We will not have trades today on them. I say that, and then I usually have this. But let's go sideways here so I can give you the full screen. I'm phoning it in today again. Okay, this is the 240-minute. We're now looking at spot gold. I'll give you Fed numbers on this. Right, the 240-minute broke out from an unsafe level. I had no trade to do on this. All right, again, long from a macro position lower, but swing trading around looking for signals. So nothing is done here, nothing to do, in my opinion. I'm in love with this chart. Why? Okay. This is spot gold on the weekly. because you can't see it unless you look really closely. I'm not going to stretch it out to infinity here. But right now, we are in a widened stance. It doesn't sound right. Where the Bollinger Bands are widening. The week isn't over yet, but we are above uh, the level to get long. Do you get long now? You can get long if you want to get long now on an incremental basis. But strictly speaking, the system says, and I'm using the spot number here, is that if we settled the week Friday at 2:30, and that's not actually the close. The close is at 5, but you can use 2:30 because that's a settlement time. If we close the week 2:30 or 2 Eastern time, I'm not sure what it was. It's based on the old Floored hours. It's a legacy of nonsense. If we close the week above 12:34, you are to go home long at the bell with a stop at either 12:34, 12:12, or 11:90, depending on your risk tolerance. So you could have wider stops and use lesser volume. But if you're a one lot trader, you would go home long one lot, and you would leave that. It's a weekly trade, and you would keep that on for as long as we don't trade. And this is the tough one. You can change your prints, you can change your spots where you get out, but strictly by the book, you would get out on a print below 1234 spot 50. This is on cash, so add about 650 for Feb, and I'll show you a Feb chart in a second. Uh, Now, I'm explaining this in detail because it's classic. This is not a day trader's thing. I'm going to give you where the day trading comes in on this. So if we settle right here, which is 1239 on spot, you would buy the market at 1239 spot 16 with a stop out Monday, or you should have your stops in at night as well. There's a 24-hour market, 1234 spot 50. Now, and you would look for a multi-week rally. And here's your criteria. Either A, you're stopped out, which you'll be stopped out very quickly if you're wrong. B, uh, you go in the money after the first 3 weeks. If you're not in the money after the first 3 weeks, you close the position. Or let's put it this way, no matter where the market is in 3 weeks, you close the position because that's a slowdown in momentum. Sorry about the sniffles. I am not snorting Ajax. Why am I in love with this chart? Because this chart is what happened here. And I caught this move for a client. And we got short. I can't put my lines here, but let's do this. The second week in May, closed, and that's a very, very, very subtle widening, and we got short. And if you notice, the market tracked sideways 3 days. We did not get stopped out, and on the fourth week, we had some nice profits, but then we got stopped out. So we made, what I mean by that is we had nice profits and we trailed our stop, and we took our profits. But had we kept short, we would have been stopped out because in that fourth week, that red candle. So if you have this, I'll just go right here. All right. So here's your signal. Big red candle down. You're short on the close. Next week, the market rallies. You're still short. Next week, the market drops. You're still short. Next week, the market rallies a little bit. You're still short. Next week, the market drops. We book our profits. Had we not booked our profits, we would have been stopped out because the wick goes as high as that. And lo and behold, because I did not give a wider berth on the stop, and I was aggressive taking the profits because I wanted to have a winner for the client. Again, this is me messing up. Uh, uh, the market kept going. So we took, I think, $13 out of what, $100 move? It's ridiculous. And what's even more ridiculous is on this bottom here, we called the bottom here. This is the week. First of all, Larry called the bottom on Twitter. And then the next week, I wrote a story saying short covering rally engaged, something like that. But we called the short covering rally as well. Now, here we are in a situation where we could have the reverse happen. And I'm excited about this. Uh, if you're long from lower, you stay long. You can get long on this. All right. Let me give you some obstacles to look for, and then we'll talk about how to day trade it. Actually, let's talk about how to day trade it first. Day trade it first by saying, I'm flat. I'm not getting long on this signal that Vince has, but I like this idea. So I'm going to use it to swing trade. Maybe you're a technician, maybe you trade flow, but this gives me the freedom to be biased bullish. Now, how did I used to express this? I'm an options market maker. I took the other side of people's positions for 30 years. I was a gold options maker designated by the CME. I was a CSO options market maker designated by the CME. I was the first CSO market maker on the floor. That did not end well because of my own errors in judgment. But that's all out there and it's all public, and you know about that. But the point is, I'm a market maker. I make markets. Uh, I step in and provide liquidity. I don't run away from it. Now, when you see something like this and you're a market maker, this is all designed because I was a gamma options trader. This would tell me to let my gamma run. Now, we're not talking about options right now, but I just want to say this. If you're long options, as I habitually was long options, I was long options side player as a product of the rest of the world being short options. Basically, market makers are dumping grounds for the rest of the world's position. So if I would be long options and I would see a sign like this, I would hedge my gamma, which means I would not hedge my gamma. I would let my potential profits run. So that's where this comes from, and it can be easily applied for swing trading. Now let's go to it's 4 hourly. No apparent help if you're bullish. Um, I would look that if we go below 1237 at $6, that's about 1243. You might get a retracement. Maybe it's a bull flag to buy. That's how you want to trade it. Okay. Uh, this is very important, and I've talked about this before, and it should never be forgotten. This is where and how the macro, forget the yellow words there. That was a prediction I made. I was wrong. I mean, I was right about the market making a bottom, but I was wrong about the market screaming higher at that moment. This yellow line is the 12-month moving average. This yellow line is the most important line if you're a macro fund player. This is the yellow line that Gunlock looks at. This is the yellow line that momentum funds, macro momentum funds, will get in and long above. If you buy when a month settles above this line, you will make money on an average of 3 to 5% a month. If you don't buy, as opposed to sell below this yellow line, then you will save yourself 1 to 2% a month below. Now, that number now, okay, in February terms, it's 1267.41 on the spot market. It's actually that's not a good number. Actually, it is. But on February, it's or the continuous front month chart, which is now February, it's 1268.88. Trust me. Well, don't trust me, but I believe very strongly that Gunlock bought when he said he was going to buy in the 1200 area, maybe a little lower. And he also said that gold was overbought when gold was trading in the 1300 area, and we had just crossed below that yellow line. So that's my tell. I'm a student of people. I think if Gunlock had bought in the lower areas, he's going to sell at this 12 monthly area, 1267 and change. So if we run, or 1268, if we run into a brick wall in that area, that's where it's all about. Stops could be gunned that we can go higher for momentum funds getting in. All I'm saying is from a macro position and you're long, consider taking positions off at a 1268 and change area on February, and consider getting long on a settlement on a monthly settlement above it. Tough to trade this on a monthly basis. Great to know what the big money's doing. Okay. Today, I have to be completely frank. Mark Chandler writes some great stuff. Definitely for the FX guys in the room. Uh, uh, I can't claim to have discovered him, but I have discovered a lot of good people who write good stuff and aren't polluted. He has a business. He's an introducing broker. I'm not. I'm just letting you know what you're getting involved in. But AM Roadmap starts in 5 minutes. Uh, I would suggest you read this. By midday, it's not worth reading. and by that I mean so much has happened. But it's like reading Barron's on the Weekend years ago. You learn from it. Okay. He talks about Asia. He's very FX oriented. He's connected politically in the East, I think. Australia. FX guys should read this. He never talks about gold, which is why I can't really use him much more than that. North America, there's a light economic calendar today. He must have a lot of Canadian clients. He talks about that a lot. Okay. At the bottom, there's a picture there. A lot of people talk about there's 1,000 words. I've seen this on Twitter, 1,000 words in a picture. Well, then just write no fucking words. That's it. Okay. You should know what that means. I do want to spend 1 second on something that I found. I'm not the first to find it, but a guy that I follow on Twitter, Bonskew is his name, at TDOK or at Bonskew, I forget, TDOK, the Dispensary of Knowledge. Very funny guy, ironic, uh, uh, as well as smart. Tough to follow if you don't have a good sense of humor. But he'd suggested a product called Koifin. Now, this is not the real time version. I don't know what the real time version costs, but we're going to start looking at this. And I'm in early conversations with the CEO there. I don't want to make too much of it, but we just connected on LinkedIn, and I really like their product. And what I think one of the things that Opportunistic Trader has been looking at is the proper charting and ticker for our site for our members. And they're in the Koifin is in the process of developing it. By no means are they the only people we're speaking with, but I really like how this is laid out. They copy is the wrong word. They emulate gold. Listen to me. Uh, Gold's on the mind. Bloomberg layout, but it's very customizable. Of course, like any Bloomberg layout, major commodities they don't have gold in there. They have the XAU USD, which is I guess gold spot. Give you an idea what this looks like. I'm not compensated in any way for this. Neither is the Opportunistic Trader, but we're speaking to them as well as other firms to have a really nice chart set up for us because the Opportunistic Trader is more than uh, uh, stories, and it's more than trade recommendations, which is the main thing it is. But I do want to say one thing before we go. Why would a person as successful as Larry Benedict has been in his career want to build a seemingly retail type of website? That question's been asked me by people considering subscribing and people subscribing, as well as uh, uh, skeptics. And I'll explain why. When you're a trader, you get paid one times. Your value is one times what you make. In sales, a sales company that's privately placed is worth two times sales. But when you've made the kind of money that a successful trader has, and I've made a lot of money, doesn't mean I have a lot of money, but I've made a lot of money. I made over $100 million for funds that I traded with, and I've never lost an investor money. I've lost myself a lot of money. But my point is this: when you've been successful trading and you have money and you have children, I'm speaking to the people who don't have children out there. Are you listening? When you have children and you've earned this money and you want a legacy for them to have to work with, a business with meat on it, something that goes beyond your own intellectual capital. Because when we're all dead, our knowledge dies with us unless it's incorporated in a website, unless it's incorporated in a product. When you want to do these things for your children, I'm not speaking for Larry, I'm speaking for myself. You do it. So when successful people are willing to put their own reputation on the line to start a new business that seems beneath them, it is not beneath them. They're giving back to the community. You're an idiot if you think that something like this is beneath someone who's successful. In fact, before we go, I'm sorry, I'm going to run a second late here because I'm going to show you a website that I created. I created this for my children and it didn't work out. And I spent a lot of money on it. And why did I do it if I was worth eight figures? Well, that was before the divorce, right? Stay with me. I'm sorry we're running a little bit late, Larry. I'm, I have a, this is an important point for me to make. If I could just learn how to type, stay with me. All right. See this site? First of all, you should know this. There's a product out there in options called Wentech. I designed it. I was his partner. Dave Wender's design is my design. And after we parted ways because of pressure from other people, uh, who shall remain nameless, I decided, and my own uh, uh, life decisions, I decided I wanted to make a website, and I partnered with a tremendous programmer who I picked for Wentech, and we created a site called FMX Connect. Now this site is dead; it has no clients. But why would a person who's worth 8 figures spend 7 figures to build a site like this? Why would he go retail? Because I wanted something for my kids, because I wanted to give something back, because a business that trades publicly is worth 10 to 20 time earnings. A trader that trades privately, whether in his house, in an office, or for a hedge fund, is only worth 20% of what he makes. That's why you create a business. So grow up. If you think, and I'm not speaking for Larry, I'm speaking for myself, it takes a lot of courage to step out from an altar of protection to do what Larry Benedict is doing. And obviously, I'm biased because I've done it. This site was tremendous, and it is no more because we couldn't get people to pay for it. And you know what? Screw them. They missed out. But we were all over the world. 7 figures I spent on this, and I was worth 8 figures. Why would I do that if I'm successful? Because I want to do something for my kids. And I also know that a business is worth 10 to 20 times earnings as opposed to 2 times sales for a trader. That's it. Have a great day. And remember, just remember,